Hey everyone, in this video I'm going to value Bristol Myers Squibb and figure out whether it's a good time to buy their stock or not. If you're new to the channel, my name is Dan. I do a lot of stock analysis on this channel. So if you're into that kind of thing, if you're into investing, please hit that subscribe button to check out more videos like this one. With that out of the way, let's get into it. So Bristol Myers Squibb is really in the pharmaceuticals and healthcare industry. Their stock has not really done much this year. It's down about 2.5% for the year. They have a price earnings ratio of close to 10. They yield about 3% right now for their dividend. And they have a market cap of about $141 billion. Now, BMY is somewhat of a dividend growth investment. As you can see, they've managed to increase their dividend every year for the past 14 years. The average 10-year cumulative annual growth rate in their dividend is 2.75%. So while it may not yield a whole lot right now, that dividend is going to increase over time, presumably. And if you look at the more recent period, for example, past 3 years, the average dividend growth has been close to 13%. So that's a good indicator. Now, as far as BMY's revenues, you can see that most of them do come from the United States, with 60% there. 24% come from Europe, and the rest of the world combined account for about 16% of their revenues. One thing that's very important to understand about Bristol Myers Squibb is their concentration of revenue. So they have 3 major customers. McKesson Corp accounts for 26% of their revenues last year. Amerisource is 20%, and Cardinal Health is 17%. So just keep that in mind. Over half their sales come from just 3 companies. It's important to note that academic research generally finds that having a concentrated base of customers is going to increase the risk of the company, as you might expect. So here's the balance sheet for Bristol Myers Squibb. They have a pretty fair liabilities to assets ratio. So liabilities account for 60% of their total assets. That's not extremely high. That's okay. They have positive working capital. Their current ratio of 1.67 is pretty healthy. That means their current assets are 1.67 times their current liabilities. They're totally safe. In fact, if you take out the inventory of their current assets and you look at that ratio, called the quick ratio, that's still well above 1. They have no liquidity issues here. And their interest coverage ratio is close to 6, which means their earnings before they pay the interest expense is about 6 times that interest expense. So they can pretty well cover that. There's no solvency problems here. They're not especially healthy, but they're in no danger. So here's a DuPont analysis. If you don't know about that, check out my video in the description. But what we're going to do is look at their return on equity and then just break it into its 3 parts. Now, I like to look at about 5 years. You always hate to look at just 1 year in isolation, like we had the most recent year. That's not going to repeat itself, hopefully. But looking at big picture, they have a pretty darn nice return on equity. It does fluctuate a lot, which I hate to see, but I'll take a bumpy profit that's higher over a smaller profit that's stable any day of the week. And as you can see here, their return on equity can go up to 40%. And it could be as low as, 0 in the most recent year, but it's pretty good overall. Now, as for the components of that return on equity, I see the net income margin is usually around anywhere from, 13 to 20%. We had obviously a bad year here and there. That's okay. That's not excellent, but that's okay. Asset turnover is pretty fair, not that impressive, but not bad. For example, last year, 0.75 means for every dollar of assets we had, we generated 75 cents in sales. Now, obviously, sales got, really hit this year. That did not work out so well for us, but, again, hopefully that will not repeat itself. And the equity multiplier, the effects of leverage. And they have a little bit of leverage, which is helping their return on equity. So companies give money to shareholders in the form of dividends or share buybacks. In the blue here, you can see that Bristol Myers Squibb has a nice steady streak of increasing their dividend. In the red, I have share buybacks per share. And they don't really have a great history of that. In fact, in 2018, 2019 is negative, meaning on the whole, they issued more shares than they bought back. So for this company, I got to keep that in mind. When I value the company, I may just want to focus on the streak of dividends. Now, companies go through phases in the firm life cycle. I would say Bristol Myers Squibb is pretty mature, but on the other hand, have a look at this increase in revenues from 2019 to the most recent trailing 12-month period. Absolutely incredible, just about a 50% increase in revenue. Now, this could be a great deal. I don't see that the market is really appreciating this increase in revenue when you look at their stock performance over the past year. I think one of the reasons that is that the company still is reporting a loss if you look at the most recent 12-month period. So even though they have this massive revenue, they're having a loss. Now, why is that? Well, if you look at their operating income, it's actually going up. So their expenses are coming mostly after the operating income, meaning unusual expenses. Just have a look at their earnings before taxes, excluding unusual items versus including unusual items. And you can see what's going on right here. The company had an accounting write-down, which reduced their profits down to nothing, but it's not expected to recur. As well, they had a pretty unusually large income tax expense relative to their profit. So if we look at this visually here, you can see in the blue, their operating cash flows are actually higher than ever, and they're just having some negative net income from some write-downs. Okay, so Bristol Myers Squibb stock looks very intriguing. At this point, I want to use a dividend discount model to value the stock. So what we're going to do is we're going to look at the expected dividends we receive from owning a share of BMY and just discount them back to present value. And we're going to compare that intrinsic value to what the stock is trading at today and see if it's a good deal or not. Okay, so we know the next period's dividend of $1.96 a share. We know the current stock price. We have to estimate a discount rate. For Bristol Myers Squibb, I was going to go with about 6.5% when you factor in their leverage, the competitiveness of their industry and everything. Just about an average discount rate. The growth rate in dividends, again, they have a nice track record of about 2.75% over the past decade. And that growth has really increased over the past 3 years. I could see about 3% forever. Increase every year. Now, if we plug those numbers in, the intrinsic value for a share of BMY is $56 a share. Now, the value does depend tremendously on this growth rate. If they can only grow dividends at 2.5%, the shares would only be worth $49 today. If somehow they manage to increase the growth to, let's just say 3.5%, then all of a sudden the intrinsic value goes up to about $65. So it is really subjective, but when you talk about growing forever, I generally going to go with a lower rate. It doesn't seem like it's that good of a deal right now, just based on the numbers. Now, this dividend discount model tends to understate the value of a company. So this is like the minimum value. That's something to keep in mind. But I would say, based on BMY's track record of buybacks, they don't tend to take their extra money and give it back to the shareholders in form of buybacks. So, while this is a floor, I think the ceiling is not that high. The final piece of the puzzle I'd like to look at is insider trading data. Here you can see quite a few more insider sales compared to insider buys, especially in the past 3 months. No insiders have bought BMY, while 12 have sold. When you look at the number of shares involved, it's about 112,000 shares sold, 0 bought. And in the past 12-month period, you have about a 3-to-1 ratio of sales to buys. So all else equal, this is a little negative. Okay, guys, so here are my final thoughts on BMY. Bristol Myers Squibb has a pretty healthy balance sheet. No danger there. They've been around for a long time. They've got a dividend growth going on. I could see it, being a decent investment. It's not going to earn you a very big return though at this price. And when you run the numbers, it really doesn't seem like that good of a deal. I'm sure you'd make some money, but it just isn't. For me, it isn't there. Every investment you make has to be compared to your alternatives. And when you look at the stock market as a whole, the S&P 500, you're subjecting yourself to no firm specific risk if you invest in that, and you can get 6 or 7% a year on that. So for me, it's like, why would I buy BMY? And so I'm gonna have to say pass on this stock. That's just my personal opinion. I hope you guys liked the video. If you did, hit that thumbs up button. It helps me a lot. Thanks for watching.